So I move here, my dad calls me up 6 months in and he says, man, I've just never seen you this happy. I said, well, Dad, I'm driving to the beach right now. It's sunny. If you saw what I saw right now, you'd be happy too. So I joke, I'm like, I'm healthier, I'm wealthier, I'm tanner, I'm happier. It's also easier to fly all around the country from here. I think today is just in general one of the most exciting times to be an apartment investor.
Can you speak to kind of markets that you're excited about in 2025?
I think
Happy New Year.
Happy New Year, Omar.
Good to have you on as the first guest of 2025.
Oh yeah, I am. I'm honored.
It's a good way to kick off the year with someone like you.
It is, in the best city in America, Miami.
That's it. That's the whole podcast. We're done. We can cut it there. So I did want to get started because for you, I mean, you've now at TruAmerica, you're the CIO there, and I'll give a whole intro sort of pre-podcast on my own, but you have a ridiculous amount of accomplishments at a relatively young age. And my first question is like, was your family in real estate? Did you knew you wanted to be in real estate and you started when you were 12, or like, what's kind of your background story?
Sure, no. So family wasn't in real estate. I first got exposed to real estate in undergrad. I went to a college in upstate New York called Skidmore College in Saratoga Springs, about 3.5 hours from where I grew up in Rochester, New York. So complete opposite weather of where we are today. And went to Skidmore really to play baseball, Division III baseball player. And our business department had a mentoring program where I was paired up with a woman who had a small real estate company doing small development. And so she was my mentor throughout college. And that really turned me on to real estate for the first time. They would build little apartment buildings or office buildings in the suburbs in upstate New York. So that was really my first exposure.
Did you major in like finance or real estate?
So it was funny because Skidmore is a liberal arts college. It used to be an all women's school, but they had a business department. So I was a business management major, but you got the full liberal arts education as well. So it's sort of kind of an oxymoron.
Yeah.
So I had a business major and that's how I got the mentorship, which just happened to be someone in real estate.
And you were mentioning that during you were in college or pre-college, you had an e-commerce business?
Yeah, so as I was graduating, I was really focused on baseball. It was my senior year, spring break. I get a phone call from a financial services company that had applied for an internship the year before. And they said, hey, would you consider a full-time job with us when you graduate? They were based in Saratoga. So I was like, sweet, I'm not even looking for a job. I'm focused on my baseball season. So I interviewed with them and I got a job offer for $33,500. And I was like, wow, I'm going to be rich. Like I made it. Like I can't believe someone would pay me $33,000. This is in 2005. So I'm dating myself. Yeah. And so I was like, probably going to take the job. I love Saratoga. I actually was running it by my father who, pretty savvy business guy, mentored to me. So, one of my best friend looked up to a lot. And he said, Matt, your brother Rich, he started this kind of website business where he's selling supplements on the internet. He's more of a computer science tech guy, not a business guy.
Older brother?
My older brother. Mm-hmm. Why don't, this was after the dot-com crash, he had a computer science degree. What if you considered coming home and partnering with him on the business? And I was like, I don't really want to go back to Rochester. Everyone in my college was from Boston, New York, or DC, going back to big cities. But I went home and I kind of looked under the hood and I was like, wow, this could be pretty lucrative. Yeah. So I moved home, but I told my father one thing. I said, look, I was very interested in real estate. I would really like to figure out how to buy like a multi-unit property. Like, could you help me and give me some guidance?
Yeah.
And back then you could get, 5% down.
Yeah.
Houses in Rochester weren't too much. And I found a 3-unit triplex in the nice Park Ave area of Rochester, probably 6 months in. I think I had to put, $10,000 down. It wasn't that much. And lived in 1 unit with a roommate, a friend of mine.
Oh, you're the house hacking.
Yep. And then rented the other 2 out, and we got this e-commerce website business going. And that was like my first foray in
like entrepreneurialism, business.
Exactly, kind of figuring it out, like lawyers, setting up LLCs, making sure you're following certain laws, having to get product liability insurance, figuring out how to advertise on the internet.
Yeah.
Back then, Google would send us Christmas presents. We were that big of a customer.
Oh, wow, okay.
We were spending like $30,000 a month on Google AdWords. No one knew how to use Google. Most people didn't know how Google made money.
It's the best time to start when nobody's,
exactly.
You got to be the ones figuring it out.
Yep. So got that going. It was super lucrative. And along the way, I started taking MBA classes at the University of Rochester Simon School.
This is post undergrad.
Yep. This is while I have the e-commerce business, just part-time, just in case, hey, maybe something doesn't go right with the business. Right. I'll work on my MBA. And after one semester of that, a couple years out of college, I was like, I really like this. Like, I would really like to go to business school full time.
You really like the MBA or something?
I really liked it. Yeah, like being back in.
I was going to say, are you like a studious guy, athletic guy? Like, I mean, probably both, but like growing up, what type of person would you describe
school
yourself
generally
as?
came pretty easy to me. Yeah. I wasn't like taking AP classes. I wasn't probably working too hard in high school, and I could get by without trying particularly hard.
Yeah.
But I got good grades when I got into a good college. Yeah. College was fine, came relatively easy. I think in business school, I was like really focused on there. You're writing a big check for it and super into being into the academic environment, where really in business school, most people are focused on networking and finding a job. Yeah. I wasn't really too focused on that. I really liked the school. And then I was actually coaching college baseball part-time at a Division III school in Washington, D.C.
And I'm going to ask this because I'm curious. Yeah. Every time I'm with you, whether it's dinner, a tour, whatever it is, you are like at 120% dialed in, super focused. Was that you at like 12, 16, 22, or this sort of just got progressively more dialed in? And you can't deny it. You are very...
I think, look, if you find things you're passionate about, it's just natural. Like, talk to me about a topic that I don't find interesting and maybe I won't be dialed in, right? Like, and I think that's like the big lesson, like just find things you're passionate about that you're going to be good at, and I think you'll be pretty motivated
into it. So then you graduate from your MBA, and then what's like your first?
So I leave Rochester, I go to Georgetown, and the GFC happens. Okay. My Lehman goes bankrupt.
Did you graduate 08? 07?
I got into business school fall of 08, graduated business school 2010, got out of undergrad 05. So I was in Rochester for 3.5 years, got our
financial crisis happens.
Yep, so Lehman goes bankrupt the first week of grad school. I remember we had our a bunch of banks came to talk to us, and they're like, yeah, LBO. And I'm like, what is an LBO? I didn't even know what a leveraged buyout was. I was like, I'd been doing something totally non-finance related. And I was just kind of focused on school. Summer comes around where you're supposed to do an internship. Like, trying to find a real estate internship in the summer of 09. Like, people are like, leave me alone. I don't have a job. Yeah. I actually never got to study abroad in college because of baseball. So I actually did a program where I went to Oxford with some grad students and spent the summer in Oxford. Came back for the second year, was coaching baseball part-time at Catholic University in my second year because I was still super into baseball. I'd coached high school baseball back home. And graduation's rolling around, everyone's scrambling for a job, and I hadn't looked for a job at all. I'd really done no networking. I was focused on coaching baseball, being in grad school. Actually toyed with the idea of becoming a baseball coach. I had actually gotten an offer from the head coach at Georgetown to be the third assistant, which is basically a volunteer role, but it would have been Big East Division I baseball. Yeah. And I had a good friend from college at Boston University who sent me a job posting for a rotational program where you would rotate around the country for 18 months with a company called Archstone.
Okay.
And he said, Matt, I think you'd be interested in this. So I applied for, it was the only job I applied for. And Archstone was the premier operator. They had arguably the best portfolio in the country, coastal gateway cities, but they'd been taken private by Lehman October 5th of 07. Yeah. So they're now owned by a bankrupt entity and a couple banks. I interviewed with them. And they said, look, we're going to use this rotational program, but we're going to do it a little differently than we have in the past. Historically, you're going to spend 6 months at our corporate headquarters in Denver. You're going to spend 6 months maybe in development or acquisitions or corporate finance. But instead of doing that, we don't really need to train people to do development or acquisitions because frankly, there's a lot of unemployed developers and acquisitions guys and gals out there. So you're going to rotate around the company, but you're going to end up in operations as a regional manager or operations manager. So would you be willing to live in Denver, New York, Boston, DC, Southern California, Northern California, Seattle? Yes. Would you be willing to move every 6 months? Yes. Would you be willing to live in one of those cities except for Denver at the end of 18 months? Yes. I was geographically agnostic. Let's go for it. So I ended up getting the job. They hired me for the East Coast, and they hired one guy for the West Coast that year, a gentleman by the name of Ben Mayberry, who's at Abacus now. and we rotated around. So I worked at a 912 unit property in Arlington, Virginia, right across.
Were you like physically at the asset? Like
right at the property
manager,
for the first
leasing,
4 months.
Whatever.
I worked on-site, 912 unit property, built in the 60s, right across the street today from Amazon HQ2. And I basically spent a couple weeks doing every on-site role. So for 2 weeks, I put on a service tech uniform. I had no idea what I was doing. Spent time with the service team. They kind of made me cut pipes and sludge go everywhere and laughed at me, and we had fun. I learned, they had a great training program at Archstone. Like you really learn to operate. The Leasing Essentials program, I worked the front desk on Fridays. I even did an overnight shift at the front desk. I worked as assistant manager. I sat in on renewal conversations. The first renewal conversation I sat on with the assistant manager, a resident got angry about their increase, crumpled up their renewal and threw it in his face. So I just learned the nuts and bolts of the business.
How much of that do you think you take away now as you're like head of acquisitions or into an acquisitions role?
Oh, it plays a role in every single thing I do.
So much, right?
Across what we do.
Most of the guys I speak with, like they've just always been an acquisitions person and, you know, relatively have less of an idea of like what it actually takes to like lease and manage and like the day-to-day of that property management business. You have that background.
Right. Oh yeah, you learn from the ground up, and that was what was so great about this fast track rotational program. So did that for 4 months, moved to Denver. I worked in procurement for 3 months, had a great mentor on that team, Lori Tobin. It was a brand new department. And I did national RFP for pest control and elevator maintenance. I knew nothing about, I spent so much time learning about bed bugs and elevators. I did that for 3 months. And then I went and worked for who was the asset manager of Archstone from Lehman, overseeing the venture. It was the summer of 2011, and we were trying to either file our S11 to go public or sell the company. And between the ownership, the ownership between Lehman, BofA, and Barclays all had different interests of what they wanted, right? And that was the summer the S&P downgraded the U.S. debt. Capital markets went haywire.
2011.
2011. BofA and Barclays, I think, wanted to sell. Lehman felt maybe they were selling short. And so Sam Zell tried to buy 25% of the company. So that sort of ended my rotation working on that. What ended up happening is Sam Zell tried to buy 25%. Lehman went to bankruptcy court and got $6 billion to match the offer. Sam Zell then had the right to buy the next 25%. Lehman matched that offer. Now Lehman basically owns 100% of the company. I think everyone thought we were going to go public. Lehman really wanted to go public. I moved to New York. And
with Archstone.
Yep, I'm with Archstone. I moved to New York now to do my next operations rotation. So this is late 2011, early 2012. And I get assigned to manage a 192 unit high rise on Montague Street in Brooklyn. And my dear friend and mentor and was my boss, Linda Early, she's now the president of Brookfield's management company.
Oh, wow.
She was the VP of New York. And she calls me up and she goes, Matt, I'm a little concerned about you coming to manage this property. Like you don't really have any experience managing a high rise. I'm thinking, man, if you're concerned about me coming to manage this 192 unit high rise, like in 6 months, I'm supposed to be a regional manager. Like,
that's a problem.
Yeah, like, wait a minute. Like, so I go there, I'm running this 192 unit high rise. You got union staff at the front desk and the tech team. I've got 1.5 people in the office with me. I'm leasing apartments. I think some kind of famous people lived in the building at the times. And so I'm like leasing apartments, managing the building. And 2 months in, Linda comes and sits down with me and she goes, Matt, I need to talk to you about something. So I'm like, what's going on? She goes, well, like you've really done a great job here and I would like to transfer you to a 550 unit property in Midtown Manhattan, Archstone, Midtown West. So I'm thinking, oh, you were concerned about me managing this 192 unit high rise, and actually Linda's a partner of mine today, and so we still joke about that. So I run the 550 unit high rise. We've got about 25 staff, mostly union.
If I may, so is this 2012, 2013?
This is 2012. We're still in 2012.
And like, how old are you at this stage? Sorry to date you.
I am 2012. I'm 30.
30. Because the reason I ask, are you now, so at 2012, 30 years old, do you have an idea of like, IRRs, like
I learned the basics of it in business school.
Yeah.
I knew we had an acquisitions team like at Archstone. I had spent a couple weeks working with the acquisition team in January of 2011. But truthfully, I had no idea that the job I have today exists. I didn't fully understand the investment side. I was just so happy to have a job at a company that I drank the Kool-Aid. Like everyone at Archstone just believed in the company. I feel like you're a
Kool-Aid drinker too, because now at TruAmerica, it's like
they had such great culture. Everyone really believed in Scott Sellers. I was rotating around. The people were fantastic. Yeah. And I was just excited to be learning a new business and doing a good job at it. Right. Like I was just happy.
So you go to the 550.
I mean, keep in mind, this is a couple years after the GFC. You want to work in real estate. Like,
it was tough to even be in there.
Like I was proud to work in operations
and
on the management side. Exactly, I loved it. To be honest, I thought I was on this fast track operations career. You know, they thought highly of me. I ran the high rise for 4 months. I became a regional manager, and so regional manager for 6 months with a portfolio in New York. Yeah. And then late November, Scott gets on a call, company-wide call, and it's like with mixed emotions. You know, I'm announcing
Scott is like CEO
Scott Sellers, CEO. You know, legend in the industry. And he announces we're being sold to a joint venture of Avalon Bay and Equity Residential. And I went to my office, I think probably almost in tears. Like I just spent 2.5 years of my career totally dedicated to this company, loved working there and being like, what am I, like, who's going to hire me after I rotated around these random places for 2.5 years, sort of have some operations experience, but not enough. Like, you know, kind of woe is me. And it was the best thing that ever happened to me in my career. Yeah. As sad as it was for Archstone to go, because it was truly an amazing company. And so I'm interviewing with Avalon and Equity Residential for regional jobs. And along the way,
was it you were either going to work at Avalon or Equity Residential?
I also was looking for other jobs because they needed operations people. They were buying a huge portfolio.
Because basically it's two REITs. Yeah, and they were buying separate parts of Archstone.
Yeah, they basically did an NFL draft. Figure like an NFL draft where they picked assets. So like I think EQR got to go first, maybe then Avalon got to pick 2.
It wasn't even my product type. It was just
they literally drafted assets around the country. You know, 6 months earlier, and then they created a joint venture for things that weren't going to be long-term strategic for either company. Yeah. And then there was a whole transition. So how it worked was, if they wanted to hire the same person, your pay had to stay the same. So they couldn't like bid you up. Oh, so they sort of colluded. And then you interviewed for a certain role. So I interviewed for regional roles with both companies.
Property management.
Yep. Property management. Yeah. And along the way, so the Avalon folks had me meet a few different people in the Boston office in Arlington, Virginia. And I spent 30 minutes with Pat Nidek, who at the time was the head of East Coast acquisitions. Yeah. And
of Avalon Bay.
Yep. Of Avalon Bay. And didn't think anything of it. So a few days later, I'm in New York. We're touring the CEO and CIO of Avalon through our Manhattan portfolio. I'd been given an offer from both companies that Monday, and I'm about to kind of make my decision. This is the day I had to make my decision. Yeah. And I get a call from Avalon. They're like, you know, we told EQR, you need one more day to think about things. And I was like, well, what do you mean? I need one more day to think about things. Like, well, would you consider a job on our investments team? And I was like, yes. And they're like, okay, you need to be here tomorrow and spend the day in our Virginia office. And I was actually on the way to LaGuardia to fly to Denver to go skiing for the weekend. So I'm like, okay, change my flight. I get on a train. I go to Arlington. I spend the day, meet a bunch of people at Avalon, spend a lot of time with Pat. And 4:00, he's like, all right, here's the situation, Matt. You can take your offer to be, you know, regional manager with EQR. You can take your offer to be on the operations team with Avalon, or you can join my team to be an investments manager. So I'm like, okay, he goes, but here's the caveat. You have 15 minutes to decide, because whatever you decide will impact who gets an offer from Avalon and EQR for the next round of people. So I'm going to leave the room, and I'll come back in 15 minutes and you can tell me your decision.
No way.
So I said, Pat, I don't need 15 minutes to decide. I'm taking the offer on your team. Wow. He goes, really? I'm like, yeah. He goes, oh, I don't hire 2 people. We shake hands. I'm like, so I'm super stoked. I've now pivoted from operations to acquisitions, dispositions, and, you know, investments.
Yeah, the investment committee.
So that's how I got from the operating side of the business to the investment side of the business.
Got it. So what was that transition like now that you're at Avalon Bay? Was it supernatural? I get it. I know these numbers. Or was it like, oh, now I have to, you know.
So I think it's a few different emotions. Number one, I relocated from New York, moved back to DC where I had gone to grad school. So I moved. We weren't going to buy a lot at Avalon because, you know, Avalon, I think they're a big developer. Yeah. They do transact a lot. I think their investments is more so portfolio. We were more portfolio shaping. Like, hey, we built so much here. Let's sell this, reallocate here.
Because as a public stock, I also think that's important. Right?
Exactly.
Like, we can't be overweight here. We can't be
focused
underweight.
on portfolio allocation, right? And our job was kind of shape the portfolio a little bit.
Right.
But they just bought Archstone. So how much were we really going to buy?
Right.
They did have some legacy funds that we were disposing. So I learned the great disposition process. I spent a little bit of time, about 20% of my time, in the redevelopment asset management group, learning how to reposition assets. So I did that. And then we started buying probably 2 years in.
Okay.
Where I remember 2 years in, I'm like, well, Pat, if I don't buy a deal, like what's going to happen to my career? And he kind of made a joke about it. We ended up buying several deals my last couple of years there.
Okay, got it.
And I loved it. Like, I think it was a little unique in the sense that, a bunch of Archstone people had joined and we were all kind of like, hey, where are we working? And so you had this kind
Where'd
of
you land?
Internal family that you're all trying to navigate this new company. But again, it was a fantastic company, like one of the premier REITs.
Amazing.
So did they do some things differently? Yes. I think what was great about the Avalon leadership is they got to really look under the Archstone hood, and the things they saw that Archstone did great, they tried to implement, particularly on the technology front. And so I think you have to give a lot of credit to the C-suite there that wanted to say, okay, they do this really great.
Yeah,
like, we just bought this company. Let's not just look at it as buying real estate. Let's also look at it as buying a company.
Operations.
And I think, they're a better company today for that.
Yeah, they're great. We sold a $130 million asset to them in Miramar here in Broward. Stu Royer.
Yeah. I had dinner with him last night.
Okay, a great guy.
Yeah.
Small world.
So Stu, actually, the role he took, he's in a much more senior role than I was there. But the role he took was my vacancy when I left.
Oh, really?
Yeah.
So you were at Avalon for how long?
3.5 years. So February 27th, 2013, or 28th was the last day of February, till August of 2016.
And now you're going to TruAmerica,
Yep.
which is where you're the CIO now. And I want to touch on this because, when I think about Avalon Bay, one of the biggest public real estate REITs in the country, and now you're going to TruAmerica, which I assume, obviously had a business back in the day as well, but like nowhere near Avalon Bay, in a place that I'm assuming you were like growing, you were valued and things like that. So like what made you want to do the transition, and like how sure were you of that transition?
Sure. I was not sure at all, and I was extremely afraid to fail. And maybe I have fear might drive me sometimes. I wasn't looking to leave. I loved working with Pat. He's a dear friend today, an unbelievable mentor. I learned so much from him. But it was funny. I was at a Nationals game for a Georgetown real estate event, and I got a call in like July of 16 by the guy by the name of Greg Campbell. And Greg had actually done acquisitions for Archstone on the West Coast. I didn't know him, but I knew of him just having worked at Archstone. And I had seen TruAmerica bidding on some of our West Coast deals that Avalon was selling. And he left me this voicemail like, hey, we're looking for basically a head of acquisitions for the East Coast. We're a West Coast firm, and we're trying to expand to the East Coast. And so I left the baseball game right away because I just seen them transacting a lot, and I knew of Greg. So I called him. We had a good call for about 30 minutes. Next day, talked to him and our CAO, Mark Enfield. And they're like, all right, we really want you to meet Bob. And so I think I flew to New York. Bob and Noah, my co-CIO, Noah
Bob
Hockman.
Hart, the
Bob
founder.
Hart, yes. We just say Bob. Bob's a legend. And so I flew to New York and I had lunch with Bob and Noah and got back. And I was like, all right, I should really kind of vet Greg. I could vet him easily because he worked at Archstone, but I didn't know who Bob was. So I called up all my West Coast contacts, and everyone at Archstone I worked with was like, Greg's amazing. You would love working for him. And then I was like, well, what about this Bob Hart guy? Because we were a West Coast firm. He'd been at Kennedy Wilson, predominantly West Coast focused. So on the East Coast, today everyone knows Bob Hart. But on the East Coast, he was not as known as on the West Coast. And so I called, some people, and they said, look, like Bob transacts a lot. He's got a great track record. He wants to do deals. If you're a young acquisitions guy and you want to build up a deal sheet and transact, there's no one better on the planet to work for than Bob Hart.
Really? That's a good recommendation.
And so it's like, all right, I'm still young in my career. I had no really intention of leaving Avalon. I love working there. But
If you're like mid-30s.
Let's give it a shot. I remember I talked to, I think some brokers in the DC Metro had suggested my name. I asked everyone's opinion and advice, and they're like, go for it. And I think I lost 10 pounds during this whole decision. I was so nervous, because I was coming from an amazing company.
Yeah, like peak of real estate.
Right, like a really great company in a great role. But this was the opportunity to sort of sit in the number one chair and kind of run the region.
Yeah.
And kind of a chance to sink or swim, be the guy, right? And so I had to tell Pat I was leaving, and it was not easy. I mean, I was pretty upset about it because I love working for him, but we've remained super close.
Good.
And I joined the TruAmerica team in August of 2016. And my role then was just a director of acquisitions.
Yeah.
When I was at Avalon, I covered basically the Mid-Atlantic in New York. And that's where I bought. And Bob said, okay, Matt, they bought a couple properties in Maryland just as I was joining, and we were tying up a big portfolio from a public REIT in Maryland right when I joined. In fact, I think I toured it with Greg and Noah while I was still at Avalon, but I was my last day was the next day. Mm-hmm. And so it was process that, and then it was super entrepreneurial, okay, Matt, go find office space. Yeah. Where are we gonna put the office? So I put the office in Ballston, right near where Avalon's office is, just because that's what I knew. Yeah. And Bob said, put a business plan together and tell me where we should buy on the East Coast.
And this was what year?
This is August of 16.
Okay. I think there was a little stock market correction that year, maybe, or no? In 2016. That's kind of when I started buying multi through a company called Lloyd Jones.
I don't remember a stock market correction, but it was the year that's when Trump got elected.
Okay.
So there was
some turbulence,
some volatility, and people were very surprised. And so I put a business plan together, did a bunch of research, went to a few markets, and I said, Bob, I think to start, we should focus in Florida.
Okay, there you go. Was it value added core, or was it just sort of geographically?
Yeah, so TruAmerica's investment thesis from the beginning, and we were mostly a joint venture buyer at the time, was suburban Class B. Bob grew up in Class B housing in Chelsea, Massachusetts, near and dear to his heart. I think at the time, a lot of people didn't pay a lot of attention to the suburbs, and Class B wasn't what it evolved into. Yeah. And so that was really our investment thesis. So value add Class B, and we're going to do 90-10 joint ventures. Okay. And we had a stable of joint venture partners, but really grew that over time. So I said, Bob, I think we should focus on Florida. And I can remember early on, between Bob and Greg, they flew out, and we would do these 5-day tours, fly down to South Florida, start in Miami, go to Fort Lauderdale, go to Palm Beach, fly up to Orlando, then go to Tampa, and just spend a whole week just getting to know everybody.
Yeah.
And
all the brokers, the markets.
All the brokers. And the first deals we bought in May 31st of 2017 in Florida was a 2-property portfolio in Orlando, and then one in Palm Beach County in Boynton Beach.
And now, what can you just fast forward to what TruAmerica is today as it relates to you guys have, call it 50,000 units?
Yeah, so I think at the time I joined, I think about 30 employees. I'll get wrong the unit count, maybe 10, 12, maybe 15,000 units, but if I'm wrong, don't hold against me, true folks. Yeah. So today we own about 42,000 units. We third-party asset manage. We don't property manage another 20,000 units. Okay. So about 60 to 60-something thousand total units that we're managing. I think we're 16 billion of AUM.
That's crazy.
And the vast majority of that was done deal by deal, raising the money individually.
Oh, really? Syndicating kind of
joint ventures. Joint ventures, not syndications, joint ventures. Institutional joint venture partners, got it. Insurance companies, the big allocators, family offices. Exactly. So that was predominantly our business. We got into the fund management business in 2020. Got it. So we now have 2 value add funds. Okay. So we've kind of played in both worlds, but really start capitalizing deals individually. And the first deal we tied up, we were hard at PSA signing, $250,000 with no equity on a deal in Southeast Florida. And I was waking up with cold sweats, we're hard $200,000. I've never raised equity, but again, I had good support between Bob and Greg and Noah, and I've never put on permanent financing. We just had a drawer of money at Avalon, right? We were a REIT. We didn't do debt.
Very different.
We had the money. So it's truly the full capital stack. Yeah. And I'm we're hard $200,000. We got to raise the money. Oh my gosh. But we did it. We got an insurance company to do that deal. And then we got another group out of New York to do the 2 in Orlando. And we closed those. And then it was just building out a team out east we had our West
So
Coast
you're living
team
in
still
Boston for the most part?
I'm living in DC.
In DC.
In Ballston, which is in Arlington, Virginia.
Oh, got it.
It's the RB corridor of Boston.
So now, I mean, you bought over $10 billion worth of multifamily properties. How has that evolved, I guess, through your time at TruAmerica? And then can you talk to me about sort of 2024, this past year we just had?
Yep.
You know, what did you guys buy where? And maybe what you guys think about 2025?
Sure. Yeah, so we built out the East Coast. We expanded into Texas in 2020. So we're truly fully national. We're even in the Midwest. So today we own, I literally say Boston to Phoenix, Seattle to Miami, and almost everywhere in between.
Yeah.
Mostly Class B, some Core Plus, some Core, just depends if we think we can make money. I think what's great about working for Bob and our platform is the box is really big.
Yeah.
And if we think that we can make money on an investment and raise the capital, then we're going to do it.
Got it.
Right? We're very different from maybe the REIT world I came from, where we were only going to be in certain markets based on what we told the street, only certain vintages, right? There was just a different messaging to their investors versus how ours on the private side works.
Right.
And so, we probably averaged $1.5 billion of acquisitions in my time there per year.
Okay.
So I was really the regional head until, a year in, Bob came to me with my operating background and said, Matt, you've done a great job running acquisitions. What if you also run the asset management team out east? Like, we're all the way in LA, you're on the East Coast, you've got an operating background. So I assumed that role in late 2017, where I had to build out the asset management team. So today I oversee asset management, Texas East, about 22,000 units of a team of asset managers, and then the acquisition team nationally, because in 2018, Greg departed the firm to start his own company.
Oh, got it.
And that's when I became the head of acquisitions, and then Noah and I became the co-CIOs. So Noah runs capital markets, I run acquisitions plus East Central Asset Management.
Got it.
But we're really kind of attached at the hip. Like I talked to him, if you look at my cell phone bill, like Noah's on my cell phone bill more than like my girlfriend or my family. And we've made a great team, just kind of working the investments.
What year did you guys become CIOs?
That was end of 18 or early 19.
How was COVID for you guys, 2020?
So like everyone in the beginning, we kind of shut down, really focused on operations. Let's make sure collections are coming up, doing well. And that was, call it March, April. And then early May, I toured a property in Tampa. It had to be the first fully marketed deal in the country. I toured it in early May, and we ended up buying it along with a deal in Orlando, closed it in September, some loan assumptions. And I think we realized like everything was going to be okay.
Yeah.
And we ended up buying a good amount in 2020, over $1 billion.
Oh,
and
smart.
It was almost all on the back half.
Yeah.
And
so you guys were active.
We were active. We were active in 21, very active in 21, like a lot. Didn't over lever. Active in 22, but realized kind of Q2, pump the brakes.
Yeah. What made you realize that
I think,
from a broker's perspective, I have my answer, but I'm just curious from your side.
Yeah, you could just see values going like this. Like every day you were bidding on a deal, whereas leading up to it, they were going like that.
Yeah.
I think also in the back half of 21, when Powell said inflation was transitory, I think we had been a big floating rate borrower. A lot of agency floating rate debt in 2020 and earlier. Made sense. Low interest rates, low volatility, value-added business plans.
Yeah.
And then the agencies weren't as competitive in early 21. So that's where I think, people to get deals done, you had banking and debt fund relations and whatnot. In the back half of 21, I think when he said inflation's transitory, but our rents were going up, 10, 20, double digits, right? Just the market was going up, doing nothing.
Yeah.
It was just, simply the market, a lot of, kind of stimulus money. We thought, well, if rent's going up this much and shelter's a lag in CPI by at least a year, how could it be transitory?
Right.
And so I think there's a couple of things we did. In early 21 and late 20, when we did floating rate debt, we bought rate caps at strikes of 75 to 150 basis points. In late 20, we had 3-year rate caps at 75 basis points. In early 21, we bought 3-year rate caps 150 to 175.
Yeah.
A year and a half later, some of those were like maybe $500,000, were worth $30 million.
Literally.
Then the back half of 22, we thought, okay.
Can you try to explain why? I mean, I know, but just for the listeners, the rate cap, and then why something that you bought for $500,000 might be worth $30 million a few years later.
Sure. So
you go and buy an asset.
Right. We go and buy the asset. We'd put floating rate debt on it. And then most of the lenders will require you to hedge it.
Yeah.
And particularly the agencies, you have to buy a rate cap. Some banks will let you swap.
Yeah.
Most banks you can swap with. And so buying a rate cap basis, okay, if SOFR, or maybe it was even LIBOR in 20, gets to a certain point, you're capped. The rate, you won't have to pay more. You get reimbursed some of the debt through the derivative.
Yeah.
And so in the forward curve in late 20, early 21 was like 50 basis points for 10 years.
Yeah.
So if you needed the max strike on some of these loans might have been 2-3%.
Right.
Basically the rate cap was like $5,000 because there was no way it was projected to go up.
Right.
So we said, all right, well,
because there wasn't that volatility.
Exactly. Yeah. So we thought, okay, if the 75 basis point rate cap was like not that much more than the 300 basis point rate cap. So let's just buy the super, super low one, and it ended up becoming deep in the money. So all of a sudden that derivative, now if SOFR goes to 3-4% and your strike's at 75, you're getting reimbursed all that excess over the 75, which means if you sold that rate cap, it's worth a lot of money.
Right.
So any asset we sold, we got a big value on the rate cap. If we didn't sell and just held the deal, we were saving on the debt.
How do you get, so now why do you get reimbursed when you sell the asset on that rate cap?
So you can sell your rate cap to someone else that could use it. So there's embedded value.
Interesting. So you can sell the asset. Let's say that new buyer is going to pay off the loan and get a new loan.
Yep.
That rate cap that you held on that loan.
I sell to just someone else. I don't know who's buying.
And you make a couple $1 million on that.
Yeah. So historically, you buy these rate caps pre-COVID. And you buy them, you have to pay 10, 20, 30 grand, and they'd be worthless. Like you sell them for like 3 grand when you sold them. But now all of a sudden, rates shot up. Your cap's super in the money. So you could sell it for a lot if you sell the asset, or if you hold and rates stay high, you now get the benefit of not paying as much in debt service because of that rate cap being so in the money.
I always thought that they just attached to the loan and kind of went with
those are
the
totally separate.
I had no idea.
Yeah.
Okay.
So the back half of 21, I think we pivoted more fixed rate debt, thinking, okay, how could inflation be this transitory?
Right.
So really,
which is such a smart thing to realize when you're seeing, rents skyrocketing still.
Right. And so, and you could still get some decent leverage with some of the banks and life cos, and too much leverage, frankly, in the back half of 21, early 22 is proven to be bad. So that ended up, I think, putting us in a position where today we're not playing much defense. Okay. Certainly, there's probably some deals that might be struggling operation and not hitting a business plan, but in general, we're still able to be on offense.
Yeah.
But in 2023, despite being on offense, just didn't make a lot of sense for what we were seeing in the market. Mm-hmm. And we actually ran some numbers. I think 2/3 of what we bid on in 2023 just didn't trade.
Correct.
So it wasn't like we were losing to someone else. Like the spread between the bid and the ask just wasn't there.
Yeah. Seller wanted 100 million, everyone came in at 80.
Right.
It's just like,
so it was the lowest transaction volume in the history of our company. We bought 2 arm's length deals in 2023, one in Southern California in September and one in Boston in December. And then we'd recapped a couple deals early in the year that were kind of lingering from 2022.
Got it.
So it was definitely a slow volume year. And you're trying to keep the team motivated.
Yeah, for sure.
And I used to tell them, look, we were doing a lot of business and people were working hard. I said, look, make hay while the sun shines. Yeah. I can tell you the sun doesn't always shine. And look, I came from somewhere in my first 2 years, I didn't do any acquisitions.
Correct.
So here you have a team that's used to doing super high volume. Yeah. And you're trying to keep them motivated in a very frustrating acquisition environment where like these are trained,
these guys want to close, want to do deals, want to
they're aggressive. And so 23 was tough, but we focused on operations, really doubled down on being a great operator. And then 2024 and late 23, feels like the market bottomed Q4 of 23, Q1 of 24. Okay. And now we've been able to tick up the volume. So this year, last year, we'll bought, I think about 650 million.
Okay.
We have 1 deal in escrow right now, and we're working on
what markets and stuff generally. Like, was it Southeast?
So 2023 or 2024 plus that one in December 23. 2 deals in Boston, 1 deal in Vegas, 1 deal in Salt Lake, did 1 in Dallas, 1 in Orlando. We did a deal in Asheville, North Carolina.
Okay.
We recapped a deal in Atlanta, and we recapped a deal in Vegas.
How much of these acquisitions from 23 to 24 were like distressed situations from, you know, what's been happening over the past 3, 4, 5 years? The reason I ask is obviously I talked to hundreds of buyers, fund managers, and many of them are like, I'm not buying anything until I see crazy blood in the streets and, you know, somewhere I can get a ridiculously good deal.
I'm happy for them to have that opinion because it means we'll be able to buy more.
Correct.
Nothing was distressed.
Right.
I think the over-levered deals that probably you read about in the news with the syndicators,
Yeah.
most of those are worth well below their loan balance. So that's like between them and the lender,
Yeah.
right? I think were there some sellers who, I don't know, maybe stressed, maybe needed a little liquidity because they have a fund with office in it. Maybe there was some of that.
Yeah.
Maybe they just had a good enough profit even with the change in value that they're still willing to take their gains and move on. We sold some deals like that. We bought 7, 8 years ago. It's like, hey, yeah, should we have sold in 21? I guess hindsight's 2020. We sold a lot. Right. But yeah, everyone would say, yeah, if you know, the values were peak then, but we could still sell today and make some money. So I haven't seen much true distress. Mm-hmm. Maybe it will come if rates stay elevated. I think a lot of lenders and owners in the distressed situations understand that this isn't mostly not an operational situation. If it is, maybe you'd want a different operator, but it's a capital market situation.
Correct.
And they're trying to work, you know, and do something that's fair for both parties and buy more time. So we didn't have any where I'd say like,
oh my God, I'm buying this at 50% of value, 70% of value. Like, it's just like, no, these numbers kind of sort of hit our mid-teen IRR metrics.
Exactly.
And it's a good deal at a good basis in a good location. And, you know, we've got money we want to put out smartly.
Right.
Assuming.
If everyone's trying to buy like deals at 50% of value, like
no,
but where asset value is down 20 to 35%, depending on what market, since the peak.
Right.
And, you know, maybe the really hot markets are the higher end of that, and the markets that didn't get as hot are in the 20s. So I think that's, again, why you're just seeing less transactions. The other thing I think of why you're seeing less transactions is we almost pulled a lot of transaction volume forward in 21 and 22. So I'll give you an example. We bought a deal in late November of 2020. Mm-hmm. We sold it in March of 22. Mm-hmm. For a fantastic return, right? Crazy. Crushed it. Yeah. Maybe best return I ever did. Well, that's because there was all this sort of COVID noise with values going up a lot, then down, and it almost feels like we're getting back to a normal environment. Yeah. So that's a deal I sold in 18 months. Yeah. If we didn't have all this COVID noise and COVID never happened, that's a deal I'd be selling today. Right. But I'm not selling it today because I got to sell it in 18 months. So we pull a ton of transactions forward, and now it feels like we have a lot of properties. If the value went up 10%, we'd be happy to sell. We bought them in maybe 20, 21, 19. Yeah. And so it feels like once we get back to more solid rent growth, rates come in a little bit, not crazy. I think they'll come in a little bit from where they are. Cap rates tighten up a little bit. Then I think all year are going to get pretty busy because it feels like a lot of deals are 10% off from where a seller would be excited to sell, and a buyer, if there's rent growth and rates a little lower, would be willing to buy. Yeah, that's where it feels like we're stuck, but there's still some transactions. And
the volatility doesn't help transactions because people don't know where to price the asset. Seller doesn't know where he's happy to sell. Buyer doesn't know where he's happy to buy. And the 10 years going up and down 50 basis points every other week.
Yeah, we're doing a lot of 5-year fixed rate debt right now. So the 5 years 3.5%, and 60 days later it's 4.5%. So it's it's
crazy.
If you were able
happened to us, we'd call for offers. Right. And within calling for offers to like best and final, the 10 years moved 35 basis points. Right. So we have to call people back, and we're like, are you still at your number?
Right. Well, I think that the message there is if you are a willing seller at a number, like, yes, you want to clear the market and go through a 6-week process, but if you've got a buyer that comes along, is willing to ring the bell at the price you want and can go hard quick and lock their debt, and it works, maybe you're better off doing that than chasing the last dollar. Correct. Because of that volatility.
Pigs get fed, hogs get slaughtered.
Exactly.
Yeah, it's a real thing.
So
when you look at, because you've got like a national purview, I mean, what are you seeing now as it relates to, you know, because I'm focused in South Florida.
Sure.
Right. And I've got this opinion that South Florida isn't struggling as much. So then sellers, and there's a lot of tailwinds for South Florida. People are still moving down here, things like that I believe sellers are a little more willing to hold on to their assets and have like a higher threshold for pain, I would call it, because they're just so bullish on South Florida on net.
Yeah.
And I'm just curious what you see sort of across the country. Is it very fragmented? There's a lot of supply here and it's down a little? So
look, we do this big market research project at the beginning, really the end of each year, beginning of the year, and going into like kind of late 23 and into 24, we kind of sort of rank the markets, what would be the strongest rent growth markets. And the reason you saw us buy 2 deals in Boston is because that was going to be one of the best performing markets, and it has been. So we're seeing, positive lease trade out, not negative new lease trade out like we do in the Sun Belt. The Midwest, we own in Columbus, done very, very well.
I think that's a factor of just like supply.
Yeah, I think there
wasn't this crazy amount of supply.
Exactly. Yep. And then I think in a lot of the Sun Belt, you're still seeing some negative new lease trade out. It's MSA dependent. So like in Austin.
Yeah, I heard Austin's getting crushed.
It's tough. In Florida, sub-market specific, but feels like we're turning a corner. Central Florida is different from South Florida. And I think, again, it's sub-market dependent. Phoenix, we own a lot in Vegas. So again, it's pockety. Sub-markets are better than others. Renewals are still flat to up. New leases could be flat to down in some of the Sun Belt. So then it just depends, how much each one is, if you're overall net positive or negative. But yeah, certainly the Sun Belt right now is
it just had so
oversupplied.
Much. There was just so much excitement over the past 5 years of the Sun Belt, and there was so much loose money that people were just putting a shovel in the ground every other day, and now that supply is meeting.
Well, the market is operating the way it should, which is if rents are going up a lot in a certain market, then developers should come in and build, and that should offset it. And don't implement policies that prevent that from happening.
100%.
Because then you get distorted
markets. That's what I love about Florida. They're like build, right?
Yes. Right, and Texas is that way, and then there's other markets that they send a lot of signals to developers of you're sort of not welcome here, and that's when you get these distortions in the market. Or
when I hear my friends that operate in the West Coast selling these buildings that are 50 years old for $800 a door or something like that, I'm like, what? I'm like, in South Florida, there's probably hasn't been one asset that's sold for $800.
When they have no turnover because there's rent control,
right?
And then when someone does move out, you can move the market to the unit to market, which is good. But it distorts the market, and there's bigger housing shortages issues in those places.
Can you speak to kind of markets that you're excited about in 2025?
I think we continue to be excited about the Boston MSA. I think some of the Sunbelt markets are going to turn a corner. I think Central, South Florida are turning a corner. I agree with you on South Florida. The 2 properties we have down here may have had some negative lease trade out, but it's not rampant. Central Florida pockets seem to be turning a corner. Jacksonville still feels like it has some time. It's going to maybe the back half of the year. Austin's going to take some time. Dallas feels like Dallas and Houston feel like they're in better shape than Austin, but I think the back half of the year they'll turn a corner. We really like Vegas. So
why?
So I think if you look at Vegas, we've been an investor there for 10 years now. We've done really well there, and I think it was end of 23, unemployment was, maybe at the beginning of 23, unemployment was 6%, it dropped to 5.1. It's still above the national average, which means there's people who can take jobs. I think it's becoming more and more of a grown-up city. And then if you look at supply, it's 2% of stock for a couple of years, where Charlotte could be 9% or Raleigh. Right. So there isn't a supply issue as much.
Is that just naturally, or is there policies that...
I think some developers are afraid to build there, so that keeps a lid on it. And then even though you think it's in the middle of the desert, it's sort of landlocked with federal land, so there's only so many places you can build. It's this market we've done well. So that one doesn't have the crazy supply imbalance like some of the other Sun Belts, which is why you saw us buy a couple of deals last year there.
Right. And then as it relates to what you guys are looking for, let's not talk about any markets in specific, but are you more excited about value add deals, core deals? I know your buy box is a little more loose than other folks, but I'm just curious what you're excited about.
I think today is just in general one of the most exciting times to be an apartment investor. Previous cycle, which we'll say ended in early 22, being a good operator mattered, but like everyone made money for the most. Like you had to really make a mistake to not make money. And then I think that attracted a lot of people into the industry, particularly in COVID, that thought it was easy money, and it's turned out not to be. I think today a deal could be marketed and the cap rate, the differential in cap rates for vintage, location, MSA, broker, whatever, is just all over the place. And we're seeing this on the sale and the buy on deals that we're offering everywhere. So you could literally bid on an 80s deal in this city and an 80s deal in that city, and this could be a 5.2 cap and this could be a 6.
Oh, wow.
And then if you look at under the hood operationally, this operator's controllable expenses are 20% higher than they should be, and this one's not. So where can I add value?
Right.
So I just think it's exciting to be buying in that time.
Right.
I think when we're looking at opportunities, it's very simple. Can we find just a mispriced deal where it feels cheap?
Yeah.
That would be great, like just a value buy. Then we call like the 3 pillars of TruAmerica value add. You know, obviously there's the renovation CapEx perspective, which we have our own in-house CapEx and construction management team, which, you know, some people are hesitant on with unit renovations, but can you underwrite the deferred properly on older assets and then do things that are accretive without overspending? I think we're great at doing that. Then can you implement technology? So is there, you know, whether it's revenue management or, you know, we actually use third-party management, but we have every management company on our own technology platform. So I can pull up on my computer and I can see who's taking a long time to close out service requests and who's closing them out quickly. And you can quickly see without like looking in arrears months and months, everything in real time, right? Your marketing spend, you know, your one chart of accounts across 8 different management companies. So can we implement technology that, are you using, you know, AI for better customer service, whether it's the leasing chatbot, things like this. I'm in the weeds on with what we do with our teams. So can we implement some levels of technology that will improve overall operations? And then can we implement institutional property management? So, you know, we're a top 5 client of most of the big management companies, but then we have this layer of asset managers, investment professionals that really drive the business plan. So combining those 2 things plus our scale, can we drive value in that way? So ideally, I buy a deal cheap, and I can do all 3 of those things in a market with tailwinds. That the market research or our 60,000 data points says that there's tailwinds. So for example, when we bought that deal in Boston in 2023, we said originally with our market research project that Boston should perform well based on the third-party research. But then we looked at the data points we had all in Boston, and guess what? Like we were seeing decent trade out, you know, not negative trade out like other markets. And so that allowed us to kind of lean in on a deal at a time when the tenure went to 5% and everyone was really scared, right? So we can use the third-party data plus our own data and then our platform to add value. So I'm looking where, you know, not just buy a deal and hope the cap rate goes down or get good rent growth. Yes, I want that to happen, but under-managed, under-operated assets in some form or fashion. It's not, value add was always defined as like renovating. And
the
I
carpet,
think,
the kitchen counter.
There's more to value add than that.
And it makes a lot of sense. I actually hadn't thought about that narrative of, so like because of the easy money, there was a lot of, you know, less professional, less sophisticated people that got into the space, and now they're probably selling assets that have a lot of meat on the bone from an operational perspective that you guys can capitalize on.
Just take expenses. Like everyone got so used to this narrative on inflation that when you look at some of the properties, like the expenses are just out of whack. And we'll be in diligence. We'll bid out the contracts.
While you were doing RFPs for pest control nationally. And
so it's funny. Like it's true. Like I literally could point to like, can we get a better elevator contract at this property that's like maybe more full service or less cost? Or can we, you know, we had a property we bought recently. We own a deal 3 miles away. It's 8 units smaller than the deal we're buying. And they're
it's 200-300 units, I'm assuming. The asset or okay.
It's a couple hundred units. So the property we own is 3 miles away. It's 8 units smaller than the one we just bought. And the trash expense at the property we just bought was double our property. Well, how does 8 units more have double the trash? So we looked under the hood and we're like, okay, we can get a new trash contract. We do this and this, and we cut the trash expense in half.
And now our 5.5 cap looks like a 5.8 cap.
Well, exactly. So like what the market might view that cap rate deal, to your point, might have been, you know, a 5.6, a 5.7, 5.8. To us, it was a 6.1. So I'm trying to add some value in some way, but I want to be very careful. there's what I call abracadabra acquisitions.
Yeah.
Hocus pocus.
Yeah.
We're just like, oh, we'll just cut the expenses.
Yeah.
Well, no, you're not just cutting the R&M because you're going to wave a magic wand. Yeah. That's where the operating hat comes on, and we try to teach our acquisitions team is prove out the expense savings.
Yeah, like how?
Yes, like you have to prove it out. Like literally bid everything out and show that you can reduce it.
Yeah.
And I think we're seeing like across our portfolio now, if you're working your vendors properly, like we're not getting increases on contracts.
Yeah.
Some are going down.
Right.
So trying to work every angle to squeeze out value.
And you also have an advantage, I'm assuming, on the insurance front because of the size of your portfolio and your company and stuff like that. Because I feel like a lot of my buyers oftentimes struggle with insurance to this day.
So there's two approaches to insurance that you'll see in the market. And this is another thing that I kind of work with Mark Enfield, our CIO. We kind of run our insurance program together. We used to have an MIP. Master insurance policy, not an umbrella. Do you know how many people I talk to like, oh, do you have an umbrella? No, an umbrella is your excess coverage after your GL.
Correct.
And so we had an MIP, 13, 14, 15, 16, 17. And what I noticed as I was trying to buy in Florida is all of a sudden our MIP got very expensive in Florida. And so there's also regional carriers. You can get a regional insurance policy for if you just have one property with a regional program. And so we actually pivoted our strategy in 18, 19, where we got off the MIP. The MIPs were more expensive, and we pivoted more of a regional program. And so there's one major carrier that really does coastal markets like in Florida, and they became more competitive. In 2023, they actually got very expensive, and Florida got pretty tough. So we have regional programs, multiple different programs we can put a property on. And then we also have our third-party management relationships. So when we had a very hard insurance market, I could use all of my programs, or I could use a management company's program. So
yeah, I remember Greystar was doing this.
Greystar has an MIP, RPM has an MIP. Most of the big management companies have an MIP that if you're a client, if you use them, you could go on.
Yeah.
So
I mean, I even saw clients not manage their own deals so they can get into the MIP.
Right, that's how hard the market was, particularly in Florida, which it's gotten significantly better. Our Florida insurance went from about $500 a door in 2013 to $2,000 a door. We did our renewal in June. It's down to $1,000 or below a door. So, but then there's property, and then there's GL and umbrella. So sometimes it might make sense. I'll go on my own property program, but use my management company's GL and umbrella program. Like you can kind of mix and match.
Yeah, you mix and match until you get your lowest sort of expense load, and that is okay with the lender and okay with you guys from an insurance perspective.
What I learned, when I had joined is like, and again, it was very different. At Avalon, we just had this insurance department, this insurance program, benefits of a REIT. It's like, well, gee, what's one of my biggest expenses? Insurance. Like I should probably become an expert on how insurance is, because that's going to drive.
It's the second largest expense.
Right. And then sure enough, it became even more and more. And so we try to get very creative. We've gone out to market to do an MIP again, and we will bid that against our regional programs. And every year we evaluate.
I mean, to a certain extent, I remember you were like moving flood zone kind of designations to the extent that you could, as it relates to having consultants look at.
Yeah. We did that. We've done that on some properties where a property might appear to be in a flood zone, but it's actually not. And there's a process to figure that out.
Right.
And we've saved 6 figures of insurance where you didn't need to buy excess flood, and you would actually have the coverage on your main policy if you did certain things to get it to get it out.
It's like a wizard.
But you do that. We do that like we're underwriting the deal. We look to do that.
How I'm curious. So like someone's 25, 30, 35 listening to this podcast and admires you, what you've done, and things like that. What are like some of the things that like at TruAmerica today you like are looking for in a new hire that gets you excited to want them? What did they see in Matt Ferrari, whatever it was 10 years ago, 8 years ago?
So maybe I need to get a life, but I wake up thinking about apartments and I go to sleep thinking about apartments. Maybe some mountains in between and family and whatnot.
Which we'll get into.
Yeah, but so like I don't need you to be the smartest person in the world. I don't need you to have gone to the best school in the world. I want people who are hungry, who are smart, who are curious, and have pretty good intuition, and we can teach you the business. And that was the thing. Like when I worked for Pat at Avalon, I'd never done transactions. And I would be working on underwriting, and he'd be in the office. I'd walk by, there was glass, and I'd see he was on the phone. So I'd go back to my cube, and then 20 minutes later, I'd walk by and I'd knock on the door and I'd ask him a question. And like, I was curious. I was always asking him questions. Like I remember we were taking a train to like Philadelphia. We were looking at a deal. It's like, I got an hour and a half with my boss to just pick his brain.
Rip questions.
Right? I'm amazed at how many people like just don't ask questions
100%.
or don't pick up the phone or like aren't curious. Like if you're curious and you're hungry, like we will teach you the business. And most of the team we built was pretty inexperienced and young and learned the business from the ground up. At TruAmerican, I think when you work at TruAmerican, you work for Bob, you get a PhD in apartments pretty quick because we transact so much. So you're just getting more reps than the average company. So I just want people who are hungry. Like if you're hungry and you want to get better every single day and you're like excited about being here, then
it's funny.
You're going to do great things.
It's such a common thread on the guests on the podcast. They think about, they're like singularly focused on like, this is what I want to optimize for. And like, this is what I wake up
like
thinking
brushing my teeth. I do my best thinking when I'm brushing my teeth. I'm like, but like, I'm not like, I don't need, the fanciest school or some, like, if you're just willing to grind and not doing anything crazy, like we all have a life. We have fun in our personal lives. But like, if you're focused and passionate about this.
And it also, you can see that too. When you're talking to people, you can see that they're like fired up about the questions that they're asking you. You can see that they are like curious about what it is you guys do and why.
Right.
And you're like, okay, you can feed off that energy when you're like interviewing someone, right? For me, it's like I sit down in front of a lot of people because people reach out and things like that. And one of the guys that we hired from Philadelphia, the moment I sat with this guy, I was like, this guy wants to work, this guy wants to learn, and this guy's curious to grow. And now he's been with our team for 2 years and he's a killer.
Right.
He's super good.
I'd say the other thing that I would tell young people, and Linda Early told me this when I was working for on the operating side, is the ability to take feedback well. And because if you take feedback well, people will give you more feedback. And I think about that from my coaching days. Like there'd be some players who would maybe do this or that wrong, and they'd sort of like throw a tantrum if you told them. So you're just like, I don't want to deal with the response. So like, I'll just let them sit in the corner. But think about, that was bad for the team, but then bad for them because they didn't professionally grow.
Right.
And so it's like we used to say, like, do you want to get bitter or do you want to get better? If you want to get better, then
here's some advice.
Exactly. And like,
I like that. I'm going to take away with that.
But that's like kind of my, I've had some of the team that I've worked with be like, Matt, you kind of manage like you're a coach. I'm like, well, I was a coach.
I kind of was.
It's like the whole sports thing.
I would be coaching.
I think college athletes can excel in our business. You don't have to be, but I think you learn really good time management at a young age. Especially D3 when you're just doing it purely for the love of the game. Like no one's paying you. There's no scholarship. It's like the true love of the game, right? Like D3, like
that's so good. I never heard that.
But I remember that. So I was a sophomore in college. I had a good first 2 years, and I remember like I got bitter at times when my coach told me things, and I almost quit. And thank God I didn't, because my next 2 years we had a great run. We made the NCAA tournament. I missed my college graduation because I was playing baseball, and I grew up so much from that. I learned good time management because my grades were better in the spring during the season. But early in my career, I would get bitter when he would tell me I did something wrong instead of getting better. And I think that really was a big influence on me, for sure. 100%. And then I coach, and then you see it in the business.
I mean, it's the first time I hear, do you want to get bitter or do you want to get better? And it's like a great phrase to just keep in mind as people give you feedback or give you
look. Now, there's a right way to give feedback. Like, don't personally insult someone, right? But you should want that. That means you're going to grow. And you see the saying too. Like I saw with my college coach, there were some guys, he just stopped talking on the team. He'd given up on them. Like they just, like once your coach or manager stops talking to you, you're just like, go sit over there and you're going to focus on the team. So I think being able to take feedback well and not getting defensive about it, you'll get more feedback and you will become better at what you're doing.
Now, talk to me about, from the personal perspective, the whole mountain thing. Because, we're friends on Instagram. We're obviously friendly outside of that as well. But on Instagram, I see you buying a deal. I see you flying to tour a property. I see you on top of a mountain wearing like snow hiking stuff. And I'm like, what's going on here? Can you how did it start? Give me the whole thing. I have no idea.
Yeah. So, I was in Bethany Beach at my friend's beach house, I think in 2013. And I pulled a book off the shelf. It was Into Thin Air, and by John Krakauer. It's a famous book about the Everest disaster in 1996, where a whole bunch of people died. Two lead guides from Mountain Madness and Adventure Consultants died. There's a whole movie about it. I read the book. I'm like, wow, this is fascinating. And then I had a roommate who was going to climb Mount Kilimanjaro. I'm like, oh, that sounds cool. So I signed up to climb Mount Kilimanjaro a year later with a friend of mine and summited that.
How long ago did it start?
This is 2014.
Okay.
This is 10
years ago.
10 years. So did that. And then I had two buddies from grad school, Trevor and Don, where
this is literally you're like hiking, sleeping,
Yeah,
trying to get to the peak atop of a mountain.
Yeah.
You know?
But Kilimanjaro is like a trekking mountain, but it's high. It's 19,346 feet or something.
Okay.
It's the tallest mountain in Africa.
Okay, right, in Africa. Yeah.
And so then I had two buddies that we would do like adventure travel. Like we went to Cuba one year, we went to Haiti one year. People were like, why would you go to Haiti? We went to Bolivia, went to Chile. And so we went to Chile the next year and we just showed up in this town called Puerto Varas. And there was this volcano, and we went to some information center. We want to climb the volcano. No climbing experience, whatever. Next thing, we're on crampons. I'm like vertical pitch, thinking I'm going to fall, having vertigo. We get to the summit of this volcano Osorno, and I'm like, oh, that was pretty cool. But we were so out of shape. Yeah. My buddy Trevor goes to buy, we had to buy water at the grocery store. Well, it's all in Spanish.
Yeah.
He buys the agua con gas, not the agua sin gas. So we're like a mile into the climb. Opens the water, it fizzes everywhere. Our Chilean guides are like laughing at us like, you idiots. Yeah. So next year we go to Bolivia and I'm like, well, what are we going to do in Bolivia? I was like, let's climb a mountain. So we booked with like local guides to climb the tallest mountain in Bolivia, 21,346 feet, Mount Sahama. Did it pure death march. I'm in like ski clothes. I'm drinking my guide's cocoa tea, like totally out of shape, not prepared for it. And just sort of did some mountains randomly, as adventure travel, but not trained for it. In 2017, I followed this guy, Adrian Bollinger. He was doing on Snapchat, it was called Everest No Filter. And he was Snapchatting, trying to summit Everest without oxygen with his climbing partner, Corey Richards. He didn't make it that year, but Corey did. And then the next year, Adrian made it, no oxygen. And so I had just climbed Mount Elbrus in Russia with a local guy.
When you say no oxygen, it's like you literally need like an oxygen tank.
Most amateur climbers will climb 8,000 meter peaks with oxygen once they get above about 23,000 feet.
Okay.
Professional mountaineers, when they're not guiding, will want to climb these mountains without oxygen.
So north of 8,000 feet.
Meters.
North of 8,000 meters, most amateurs would need an oxygen tank.
Usually above 7 to 7,300 meters, you'll put oxygen on.
Okay, that's like because you're so high up that it's like shortness of breath.
You eventually get in the death zone, and if you spend too much time there, you'll die.
That's great. Okay, and then...
So I climbed Mount Elbrus in Russia. I felt like I was going to die in this storm. So I'm like, I got to learn to do this the right way. So I look up Adrian's climbing company. I go to their climbing school in Mexico. Yeah. And I climbed the first and third tallest mountain in Mexico, Pico de Orizaba in Ixta. Didn't climb for a little bit. COVID hits. This is actually how I ended up in Miami. Okay. COVID hits.
The outro is Miami, by the way. So finish.
Yeah. So the end of 20, I signed up to climb Cotopaxi in early 21 with Alpenglow Expeditions. And there they did what's called a rapid ascent. So you actually pre-acclimatize at home. So I have a machine with like a head tent, and you set it each day so there's less oxygen in the air. So I was able to go land in Ecuador and get to 19,000 and change feet in 48 hours because I was pre-acclimatized in this sleeping machine.
Yeah, so I've seen pictures of this. It's like a tent.
Yeah, it goes over your head. My girlfriend thinks I'm crazy. She kicked me out to the guest room. So I climbed.
And what it does is that it like copies.
Basically, it lowers the amount of oxygen in the air. So you're sleeping at the equivalent of the higher altitude. It doesn't adjust for the barometric pressure, but just the oxygen level. So your body will start naturally building red blood cells at home. So that when you get to altitude, you are able to function.
It.
So I climbed Cotopaxi.
Do you sleep with that every night?
No, this is only 30 days before I leave for a trip. For Everest, it will be 60 days.
Got it.
So
because you haven't done Everest yet.
What's that?
You haven't done Everest
yet. I climbed the North Col of Everest in the spring of 2024, which is 23,000 feet. So just before you'd start using oxygen on the Tibet side. Okay. There was a story about it in Commercial Observer. Okay. I'll send it to you.
Really? Yeah.
Yeah, it was pretty cool. So I climbed Cotopaxi in early 21, and on the way home, I was seeing a lot of my friends spending time in Miami. Yeah. So this will be my tangent with how I ended up in Miami. Yeah. So I call up one of our management companies who manage a couple properties in Brickell. I'm like, hey, what do you have in Brickell? At the time, they're giving 2 months free. Yeah. No, I think a 1-bedroom was $2,100, small 1-bedroom with 2 months free rent.
In Brickell, right?
In Brickell.
Yeah, I think I remember Maison.
Maison, I lived there.
Yeah.
So I'm on my layover, I tour a couple deals. I'm like, I'm just gonna like get an apartment here and set up residency, save on taxes. And like, I'm on the road all the time.
Right.
So if I'm here for the weekends and like Friday to Sunday, like no big deal.
Yeah.
So Bob calls me up like a week later and he's like, Matt, I'm on all these Zoom calls. I think the vaccines have just come out with COVID. Yeah. He booked a trip to come spend a week with me in Florida. Goes, we should have an office in the Southeast. We have such a big presence down here. We'll have better coverage, closer to assets. I was like, I think it's a great idea. What about Miami? He goes, yeah, that would be good. So I signed a lease for the apartment. Like, he didn't know. We joke about it now. And then I told the Arlington team, anyone who wants to relocate to Miami can. Yeah. And I have like 7 people here. So I ended up keeping a place in Virginia and Miami for a year, and then permanently was in Miami after that, but spent most of my time here.
So now you've been here for how long?
Since February of 21, bought a condo in February of 22.
You're in Edgewater, right?
Edgewater. Yeah. 32nd and Biscayne. Yeah. Like that was the thing. If you're gonna live in Miami, you should see the water when you wake up.
Yeah, and the Edgewater view is great.
And so I moved here. My dad calls me up 6 months in, and he says, "Man, I've just never seen you this happy." And I said, "Well, Dad, I'm driving to the beach right now. It's sunny. If you saw what I saw right now, you'd be happy too." So I joke. I'm like, I'm healthier, I'm wealthier, I'm tanner, and I'm happier. Yeah. It's also easier to fly all around the country from here. So actually, mountain climbing sort of is part of the reason I ended up in Miami, where there are no mountains.
Right. So but South America, you know.
It's a gateway to South America, and some of the best climbing is in Ecuador.
Right.
And so then I wanted to climb. I'd done 2 of the 7 summits. I'd climbed Kilimanjaro and Mount Elbrus in Russia. I wanted to climb Aconcagua, which is the tallest mountain in the Western Hemisphere in South America. And so late 22,
Ecuador, too?
It's in Argentina.
Okay.
So late 22, I signed up for that to go climb it in early 23. It's almost 23,000 feet tall, but mostly just hiking. It's not technical, but it's high.
Yeah.
And unfortunately, we go and we just get dumped with snow. Like the snowiest Aconcagua has been in 10 years. Yeah. So we get about 200 meters from the summit. We're like snow thigh high. No. We're moving 50 meters an hour, just gas with our group. And our guide's like, look, another storm's coming in. We got to bag it. So that was super disappointing to not make it. It was the first time I hadn't summited a mountain. But I think you learn a lot from failing.
Right.
And I think that made me hungry. So I'm like, I want to really train for this. Because I'd never been an endurance athlete. Mm-hmm. So then that summer I went to Kyrgyzstan to climb Lenin Peak, which is 7,300 meters. So over 20,000 feet. Again, bad weather. We get to about 21 and change, 22,000 feet. My conditioning was good, but probably still could have been better. But big mountain in Kyrgyzstan, like who's been to Kyrgyzstan. And then from there, just got more and more exposed to our guide company and the guides, and they're guiding 8,000 meter peaks. And so I climbed Cayambe at the beginning of 24. And then I went to Everest the first time the Tibet side was open in 5 years since COVID, which is controlled by China. Most of what you see on Everest in the news and mostly people dying is in the Nepal side. Super crowded with those big lines. So the Tibet side is basically empty because no one's gone for a while. And my goal this time was to climb to the North Col, just not to the summit, just to 23,000 feet. There's a really cool snow slope you go up on fixed lines. So finally broke 23,000 feet on that. And then I was going to climb Mount Blanc in August, went to Chamonix, but a few people actually died just when I got there. And my guys like, the conditions are dangerous, like better to come around the year. We did some other really cool ridge climbing.
Yeah.
Just went back to Ecuador in November and climbed Antisana, which is the 4th tallest mountain in Ecuador. So I've done the 2nd, 3rd, and 4th.
What's the first?
Chimborazo, about 20,500 feet.
So do you plan it in a way where like it keeps getting incrementally harder, and it's like you'll get to the first in Ecuador and you'll get to the top of Mount Everest? Like,
I mean, I've definitely moved in that direction, but like Cayambe is not like that hard, and Antisana is a little more technical with some pretty cool conditions. But Ecuador is a 4-hour flight from here, and so like I can be on an 18, 19, 20,000 foot mountain in Ecuador, or I could fly 6.5 hours to Rainier in Seattle, the tallest. Not the tallest, but one of the best glacier climbing, 14,000 foot peak. So like, there's just great climbing in South America. And then the Everest season will start the end of April. But again, we pre-acclimatize at home. So we do it much quicker than a normal Everest expedition would be 60 to 75 days.
Right.
You can do it in 3 to 4, maybe 5 weeks, depending on the weather.
Got it. Because it's
You
really
cut
my
it
few
down.
friends that do this, like they're out for weeks type of thing, right?
And you got at base camp, you got 5G cell service. You're in China, paved road to base camp. Once you get to advanced base camp, you've got slow satellite Wi-Fi. So I had like a desk and a chair and this big 10 on my computer, and I'm 12 hours ahead, but doing some work calls. And once I'm at advanced base camp, it's like.
So Mount Everest, is that like the ultimate goal, or what's the?
It never was, but now, that's my plan in the end of April.
Is there end of April? Oh, like this year?
Yeah.
Oh my God. Okay. Huge.
Yeah.
And now I do want to finish talking about your experience in Miami over the last 3 years. How do you like it?
It's amazing. The weather's amazing. Obviously, it's a business-friendly climate. You don't have state income tax. I fly every week, so I'm able to fly all over the country.
Yeah.
I have a lot more people in the industry that I don't know if they really want to have dinner with me or if they're just trying to expense their airfare when they come to Miami on vacation. But a lot more people in our industry are coming through Miami all the time.
Yeah.
I think the restaurant scene's amazing. There's a new one opening up. It seems like every other week.
Yeah.
But I think in the past, like I would have thought of Miami, like before COVID, as like more of a bachelor party service sector city.
Yeah.
And I think COVID really reinvented the city,
Yeah.
and it's become more of a professionalized city.
Yeah.
And so I think there's more and more people in our industry setting up offices here.
100%.
It's pretty wild. I think it's become. It used to be you came to Miami like, well, what does everyone do for work? And now like you can explain it more.
Yeah. It was sales and like real estate generally.
Exactly.
But not big private equity real estate, like residential,
And now I also.
I've got friends now that live here, right? Make $500,000 plus, and they work at Stripe, Facebook, Visa, Google, Citadel, Coinbase.
Real professionals. And so what happened was.
I'm talking to them like, you guys did not exist here.
Right. Well, in early 21, 22, like what was great too is I had some friends of friends introduced, but I made a ton of new friends because everyone was new.
Right.
So everyone was like, everyone had relocated. Everyone was willing to get to know you.
Yeah.
And so now I have like this great group of friends. Yeah. We have a great team here. It's easy to get around. And I think that some people are like, well, how could you live in Miami? How could you be married in Miami? How could you have kids in Miami? Like, it's crazy. And like, I've been training for mountaineering for the past 18 months, 2 years now. Like, yes, we go out to dinners. Yes, there's probably some drinks had. Yes, there's the occasional late night, but it's also a super healthy and fit city.
Right.
And
that's what I feel like a lot of people misunderestimate about Miami.
Right.
Most of the people here are like healthy, fit.
Go to a 10 a.m. yoga class in like Design District and it's like packed, right? Like I went running on the beach. I work out, we're members at the One Hotel Beach Club. I work out at the gym there. I go running up on the beach. I mean, it is packed with people super active.
I did sunrise yoga this morning at 6 a.m. like with the sun rising in South Beach. There was no less than 100 people there on the sand.
I think the other thing is everyone's fit and healthy, so it's almost like peer pressure.
Dude, everyone that I know that moves here from New York are like, I gotta get fit.
Right, and then you're always at the beach, like you're in a bathing suit. So like it almost, and so I read the book Outlive a year and a half, 2 years ago. Peter Attia. And ironically, the training for mountaineering is also the training for just living a long time, other than make sure nothing happens on the mountain. But you read that and you're like, it's motivating. I'm now in my 40s, like you want to stay healthy. And then you wake up and you just look around and you're like, well, everyone else is healthy and fit. Like I got to be healthy and fit. So in a way, but that's good for your longevity and your health. So,
I don't know if you've done it. There's a Brickell Run Club every Tuesday at 7.
Okay.
There's no less than 150 people. Meet up at 7 p.m. and run like 3 miles. And
in the evening?
Right here, like across the street. And they'll run. It's like a stampede and like they block traffic, but they do it every Tuesday. And for me, it's like during COVID, they would do it a lot.
Right.
Phenomenal. You meet 150 young professionals that all live in the city, all are healthy, all like work there. It's a good environment.
I think the other thing about Miami, like I'm on the ULI council and there's people from all over the country, San Francisco, LA, New York, Chicago, DC, all these big cities, all the big gateway cities. And we're sitting there and they're talking about like urban versus suburban apartments. And some of them are just lamenting about how bad it's gotten in the urban areas of their city. I said, everyone hold the phone here. Okay, let's remember one thing. Real estate is very local. And you're describing the urban area where you live. Come to Miami, walk around Brickell in the middle of the day. You'll see young professionals, people eating out. I mean, Brickell's packed and booming, so much energy. So I know your city where you live is like that, but not every city's like that. And I see it every day. And it's amazing the energy that you see when you come to Miami, just walking around Brickell or downtown or whatnot. I mean, it's and it's funny. I've met with investors and people from Europe and like, oh, we come to Miami all the time. It's like the capital of the country now.
Yeah.
Because everyone's here.
So for me, another big reason why I didn't travel right now during the winter, all my clients from Turkey to Canada, to New York, Boston, they're all here.
Well, that's just so I'm on a plane every
why
week.
would I leave?
We didn't travel over the holidays. Like, why would you? 75 degrees.
Everyone's here.
Right. And it's so I like to ski. It was a lot easier to be away a lot of weekends when I lived in DC to go skiing because like who wants to be in DC in the winter? But here the opportunity cost is high. Like this is December through really the season got extended to mid-May with F1.
Correct.
Right. And it's just there is something going on in the city every week.
Special.
It's amazing. And I couldn't be happier being here.
We'll close it out there.
Yeah.
Matt, can't thank you enough for being here. Really
Thanks for having me.
Appreciate it.